All right, today we're jumping into a really fascinating, kind of weird situation in the tech world. It's all about a company called Valens Semiconductor. And this story has it all. We're talking cutting-edge tech, self-driving cars, and get this, a massive $82 million data glitch that's got the market totally scratching its head. So let's just get right to the heart of the mystery, the big question that makes this whole thing so interesting. How on earth can a high-tech company sitting on almost $100 million in cash and with zero debt be priced like it's about to go bankrupt? I mean, it just doesn't add up, right? Something is seriously wrong with this picture. Well, here's the answer. And it's a classic case of mistaken identity. You see, there are actually two companies out there with ticker VLN. The one we're talking about, Valens Semiconductor, is a super modern chip designer for cars based in Israel. But there's also Velan Inc., a Canadian manufacturer of giant industrial steel valves. You literally could not pick two more different companies. One is all about lightweight tech, the other is old school heavy industry. And this mix-up created something the analysts are calling the phantom burn. Basically, the trading algorithms, the bots, saw a huge $82 million loss from the other company and just slapped it right onto Valens Semiconductor's financials. And just like that, poof, a totally fake bankruptcy story was born out of thin air. So, believe it or not, this kind of thing actually has a name. It's called a ticker collision. And it's pretty much what it sounds like. It's an error where the automated bots that scrape financial data get confused. They see the same ticker, VLN, in two different places, and they just smush the data together, creating this Frankenstein monster of a financial profile that is completely wrong. And when you look at the actual numbers side by side, it's just wild. Look at inventory. Valens Semiconductor has about $11 million worth. That's normal for a company that just designs chips and doesn't build them. Now look at the valve maker, Velan, a whopping $137 million. And the real kicker? Velan had over $100 million in restructuring costs, which the algorithms just wrongly pinned on Valens, a company that has no restructuring costs, no debt, and a ton of cash. It's a total mess. Okay, so now that we've sorted out that whole $82 million mess, let's talk about the real company here. What does Valens Semiconductor actually do? And what's the story behind the error? So if you look at where their money comes from, Valens's business really has two main parts. Right now, the big chunk, about 3/4 of their revenue, is from their established professional audio-video business. The other quarter? That's from their automotive division, and that's the part everyone's watching for future growth. And here's the thing. Far from being a company in trouble, Valens is actually crushing it. Check this out. In their last quarter, they didn't just meet their goals, they beat them. On revenue, on gross margin, on earnings, beat. This is what a healthy, growing company looks like, not one that's about to go under. So here's how you should think about these two parts of the business. The Pro AV side, that's their steady, profitable cash cow. It's the established business that just keeps generating money. And that money is being used to fuel the R&D for the other side, the automotive division. That's the high-growth, high-potential future of the company. One funds the other. And that financial strength is just huge. It gives them an incredible advantage. With all that cash and zero debt, they have enough money in the bank to run the entire company for 4.5 years. Think about that. That's 4.5 years where they don't have to worry about raising money. They can just focus on getting their automotive tech ready for the big time. That's a massive luxury. Right, so all that cash isn't just for playing it safe. It's the fuel for their really big ambition, which is to become the standard for a super critical piece of technology in cars. So modern cars, especially EVs, have some major data problems. First, all that high-voltage electricity creates a ton of electronic noise that can mess with data signals. Second, to fix that, you need heavy cables, which adds weight and kills your battery range. And third, with things like 8K cameras, you just need to move a mind-boggling amount of data really, really fast. And this is where Valens comes in. Their technology, called MIPI A-PHY, solves all three of these problems at once. And here's the most important part. It's not just one solution among many. It is the only globally standardized solution that can do this. That's a huge deal. The report we're looking at uses a perfect analogy for this. Think of A-PHY as the nervous system for a self-driving car. It's the technology that connects the car's brain, the central computer, to all its senses, like its cameras and sensors. Without a reliable nervous system, the brain is useless. And listen, Valens isn't trying to do this alone. They've partnered with the absolute heavy hitters of the industry. We're talking Samsung, who's putting the tech right into their sensors. We're talking Mobileye, the dominant player in self-driving computers, who has given it their stamp of approval. And Sony, the king of image sensors, is now selling cameras with Valens tech built right in. You can't ask for a better endorsement than that. Okay, so let's recap. You've got this fake story born from a data error on one side, and on the other, the reality of a super healthy business that's about to set a new industry standard. So how do we connect the error to the opportunity? Let's get to the final verdict. The analysis we're sourcing from suggests this whole mix-up has created a pretty big opportunity. You can see it right here. At the time of the report, the stock was trading around $2.50, but the analyst target for a year from now is $4.50. That's a huge potential gap, based on the idea that the market will eventually figure out its mistake and price the company on its actual, reality. So to boil it all down, the positive case here really rests on three big ideas. First, you're basically betting against a computer glitch. Second, their A-PHY tech is on track to become the industry standard, which is an incredible competitive advantage. And third, they have a fortress of a balance sheet with tons of cash and no debt to make it all happen. Now, of course, it's not all sunshine and roses. The analysis is clear about the risks. You've got to remember a lot of their current auto business is tied up with one big customer, Mercedes-Benz. Also, car companies move slowly, so adoption can take longer than you think. And finally, the company is based in Israel, so you have to factor in the geopolitical situation in that part of the world. And that really leaves us with a bigger question, doesn't it? The Valens story is fascinating, but it's also a powerful reminder. In a world where so much of the market is run by algorithms, what happens when the code gets it wrong? It makes you wonder what other mistakes might be hiding in plain sight.